RBI Governor Sanjay Malhotra మాట్లాడుతున్నారు లైవ్ లో చూద్దాం.
To a nearly 6-year low, in fact 69 months to be precise, to 3.2% in April 2025. This was led mainly by food inflation, which recorded the 6th consecutive monthly decline. Fuel group, which had been earlier witnessing deflationary conditions, there was a reversal of the deflationary conditions, and it has recorded positive inflation prints in the last 2 months of March and April. This is partly because of the hike in LPG prices. Core inflation remained largely steady and contained during March and April, and this is despite the increase in gold prices, which exerted an upward pressure. The outlook for inflation provides towards benign prices across major constituents. The record wheat production and higher production of key pulses in the Rabi crop season should ensure adequate supply of key food items. Going forward, the likely above normal monsoon, along with its early onset, augurs well for Kharif crop prospects. Reflecting this, inflation expectations are showing a moderating trend, and this is more so for the rural households. Most projections point towards continued moderation in prices of key commodities. This includes crude oil, which is of critical significance to us. Notwithstanding these favorable prognoses, we need to remain watchful of weather-related uncertainties and the still evolving tariff-related concerns with their attendant impact on global commodity prices. Taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 25-26 is now projected at 3.7%, as I mentioned earlier. This is a downward revision from our earlier forecast of 4%. We are projecting inflation for Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%. The risks are evenly balanced. I'll now come to the external sector. With a moderation in trade deficit in Q4 24-25, alongside strong services exports and remittance receipts, the current account deficit for last year 24-25 is expected to remain low. We are yet to get the final figures. Furthermore, despite rising geopolitical uncertainties and trade tensions, India's merchandise trade remained robust in April 2025. As imports grew faster than exports, trade deficit, however, widened during the month, which is the month of April. Going forward, net services and remittance receipts are likely to remain in surplus, counterbalancing the rise in trade deficit. The current account deficit for this year, 25-26, is therefore expected to remain well within the sustainable levels. On the financing side, in 24-25, foreign portfolio investment to India dropped sharply to $1.7 billion as foreign portfolio investors booked profits in equities. Net foreign direct investment, FDI, too moderated. I would like to take a moment over here because there has been large and widespread commentary on this moderation of net FDI. Now we look at net FDI primarily because of our concern regarding foreign exchange reserves, where the net becomes important. It's not only the net the inflows but also the outflows, which actually lead to either an accretion or a depletion in the foreign exchange reserves. However, when it comes to investment, then it is the gross FDI which is actually important, and gross FDI last year actually increased and increased quite sharply. 14% is a very robust growth that we had, 81 billion US dollars. And so India continues therefore to be an attractive investment destination, despite there being a moderation as we are seeing in net inflows, which is primarily because of rise in repatriation, which is again which is a very good sign of a maturing market where foreign investors can enter and exit smoothly, and at the same time higher gross FDI, which is again a sign of our large industrial and other companies going out and investing. So on the whole, gross FDI is high, which indicates that India continues to be a good and attractive investment destination. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at 691.5 billion US dollars. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. We remain confident of meeting our external financing requirements. Now I come to liquidity and financial market conditions. You are all aware that the RBI over the last few months, in fact since January, we have injected a lot of durable liquidity through various means, through OMOs, through the CRR rate cut, through the buy-sell swaps, OMOs, etc. A total of 9.5 lakh crore rupees of durable liquidity has been injected into the banking system since January. As a result thereof, after remaining in deficit since mid-December, liquidity conditions have transitioned to a surplus at the end of March. And this is also evident from the tepid response to the daily VRR auctions, which got a bid coverage ratio of only 0.26 in the recent past, and also from the high STF balances. They are averaging about 2 lakh crore rupees in the last 2 months, that is April and May. Similarly, reflecting the improvement in liquidity conditions, the weighted average call rate, which is the operating target for the monetary policy, this traded at the lower end of the LAF corridor since the last policy. The comfortable liquidity surplus in the banking system has further reinforced transmission of policy repo rate cuts to the short-term rates. However, we are yet to see a perceptible transmission, although there are incipient signs of transmission to the credit market segment, but it is still not perceptible, although we are aware and we need to keep in mind that it does happen with some lag. The Reserve Bank remains committed, as we mentioned earlier, to provide sufficient liquidity to the banking system. To further provide durable liquidity, it has now been decided to reduce the cash reserve ratio, the CRR, by 100 basis points. I repeat, we have decided to reduce the cash reserve ratio by 100 basis points from 4% to 3% of net demand and time liabilities. This will be done in a staggered manner during the course of the year in 4 equal tranches of 25 basis points each, coming into effect from the fortnights beginning September 6, October 4, November 1, and November 29 of this year, which is 2025. The cut in CRR would release primary liquidity of about 2.5 lakh crore rupees to the banking system by the end of November 2025. Besides providing durable liquidity, I would like to emphasize over here and highlight that it will also reduce the cost of funding of the banks, thereby helping and accelerating the monetary policy transmission to the credit market. I would like to reiterate that we will continue to monitor the evolving liquidity and financial market conditions and proactively take further measures as may be necessary for liquidity and for monetary policy transmission. I will now come to financial stability. The system-level financial parameters of the scheduled commercial banks continue to be robust. The asset quality parameters, liquidity buffers, and profitability parameters have shown further improvement. The credit deposit ratio for the banking system at the end of December 2024 was at 81.84%. This is broadly similar to what it was a year ago. Similarly, the system level parameters of NBFCs too are sound with comfortable capital position and improved GNPA ratios. The stress witnessed earlier in retail segments like unsecured personal loans and credit card receivables portfolio has abated, while the stress in microfinance segment is still persisting. Banks and NBFCs active in these segments, however, are already recalibrating their business models, strengthening their credit underwriting practices, and stepping up their collection and recovery efforts to avoid any excessive buildup of risks on this front in future. I now come to the end of my statement. On both inflation and growth fronts, the Indian economy is progressing well, and it is broadly on expected lines, and this is despite the huge uncertainty that the global uncertainty that we have. Strong macroeconomic fundamentals and benign inflation outlook provide space to monetary policy to support growth while remaining consistent with the goal of price stability. As global environment remains uncertain, it has become even more important to focus on domestic growth amidst sustained price stability. Accordingly, today's monetary policy actions should be seen as a step towards propelling growth to a higher aspirational trajectory. Here I would also like to highlight that there is no tussle between price stability and growth in the medium and long term. Price stability preserves purchasing power. It imparts certainty to households as well as to businesses in their savings and investment decisions, and it ensures congenial interest rate and financial conditions, all of which foster consumption, investment, and overall activity and therefore growth. Moreover, this is crucial for equitable growth and shared prosperity because its absence is disproportionately burdensome on the poor. I must also add over here that while price stability is a necessary condition, it is of course not sufficient to ensure growth. A supportive policy environment is vital. And this is even more important during periods of high uncertainties such as the current times that we are witnessing. At the Reserve Bank, therefore, while price stability remains the focus of monetary policy, we are not oblivious to putting in place complementary monetary as well as credit policies and regulations that support growth and prosperity. Thank you, Namaskar, and Jai Hind.